This is episode 29 of EO Radio Show. Have you ever heard the phrase, "You'll have to exercise expenditure responsibility" as a condition for giving or receiving a grant, and then decided to just go do something else? It's too hard, too complicated, gets IRS scrutiny, just too scary. Expenditure responsibility, or ER as the foundation world refers to it, won't send you to the ER, but it can be bewildering and confusing until you've been on the giving or receiving end a few times. But it's really not that complicated. In this episode, I'll explain what it is, why and when it applies, and how to comply with the requirements. Welcome to the EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. Expenditure responsibility is a creature of the private foundation excise tax rules, which are codified in Section 4945H of the Internal Revenue Code. Expenditure responsibility means that the grantor private foundation uses reasonable efforts to do three things. First, establish adequate procedures to see that the subject grant is spent only for the purpose for which it is made. Second, to obtain full and complete reports from the grantee on how the funds are spent. And third, to make full and detailed reports on the expenditures to the IRS. Now, like all things involving U.S. federal tax law, there are some exceptions and nuances to these rules that aren't going to be covered in this episode. The goal here is to give you the basics, so that if you think ER might apply to your grant, you have the basics down, and perhaps with the help of a tax professional, you can make or receive the grant and comply with the rules without too much fuss. So let's start with the what. What is ER? A little tiny bit of background to set the stage here. These rules are part of the federal penalty tax rules, which came into the law back in 1969 when Congress established a number of rules that apply to 501c3 charities that are classified as private foundations. For a refresher on the classification of 501c3s between public charities and private foundations, there are several episodes of this podcast that describe these concepts, and they'll be noted in the show notes. Generally speaking, the ER rules apply to private foundations, and the only public charities that have to be aware of these rules are those public charities that operate donor-advised funds. Sometimes ER does apply to donor-advised fund grants, but that's really more or less beyond the scope of what we'll talk about today. So, as a private foundation grantor, why do we care about these rules? Well, the short answer is that it is extremely expensive to a grantor private foundation if it ignores these rules when they apply. There is a steep penalty tax on the foundation, and even the individual foundation managers can face a penalty tax. I'll go into the tax details at the end of the episode, so for now, just take it on faith that it is almost never worth it to take the approach that the tax may be an acceptable cost for a grant. It won't be. Now, when does ER apply? A grant made by a private foundation to another organization is subject to the penalty tax unless the grant meets certain requirements or is made to certain types of organizations. Grants made by private foundations to organizations will be considered taxable expenditures unless the grant meets one of the following three criteria. Number one, the grantee is a publicly supported charity described in paragraph 1 or 2 of Section 509A, or is a supporting organization described in 509A3 other than an organization described in Clause 1 or 2 of Section 4942G4A. Okay, that's a lot of references, but basically it's grants to certain types of supporting organizations also require expenditure responsibility. Number 2, the next of the three types of grants that are permissible and are not taxable expenditures. The second type is a special type of private foundation that is classified as an exempt operating foundation. And number 3, the final category of grant for which a private foundation is not subject to the penalty tax is a grant to an organization where the private foundation exercises expenditure responsibility. So there it is. So in practice, we often see ER when the grantor foundation wants to make a grant to a nonprofit other than a 501c3, for example, to an advocacy organization that is a 501c4, or to a foreign nonprofit that has not obtained a determination letter from the IRS. And even in some cases, a private foundation might make a grant to a for-profit business. So these are the types of organizations that are not public charities under 509A. They're not exempt operating foundations, but the private foundation wants to make the grant anyway for good reasons. So here, it's important to keep in mind there are many situations where the charitable grant can be made to an organization that is not a public charity. So being familiar with and comfortable making an ER grant can really help the grantor foundation promote and achieve its charitable mission. So next on our questions, how do we do an ER grant? There are 5 basic requirements for a private foundation to follow if it needs to satisfy the ER rules. Number 1, the grantor needs to engage in sufficient and appropriate pre-grant inquiry, which is just another way of saying appropriate due diligence. Number 2, enter into a written grant agreement with the grantee that includes appropriate limitations on the charitable use of the grant funds. Number 3, require written reports from the grantee on how the funds are used. Number 4, disclose the ER grants on the annual IRS Form 990-PF. And number 5, maintain appropriate records. So here we'll do a closer look at each of these 5 elements. Appropriate pre-grant inquiry means sufficient due diligence under the circumstances concerning the potential grantee, which is complete enough to give a reasonable person assurance that the grantee will use the grant for the proper charitable purpose. The inquiry should concern itself with matters such as the identity, prior history, and experience of the grantee organization and its managers, any knowledge which the private foundation has, based on prior experience or otherwise, of or other information which is readily available concerning the management, activities, and practices of the grantee organization. The scope of the inquiry might be expected to vary from case to case, depending on the size and purpose of the grant, the period over which it is to be paid, and the prior experience which the grantor has with respect to the capacity of this particular grantee to use the grant for the proper purposes. So number 2, we just covered the first part. What is appropriate pre-grant inquiry? Now the second element, the written commitment, the written grant agreement. The foundation must obtain a written commitment signed by an appropriate officer, director, or trustee of the grantee. The written commitment must include 4 basic provisions. First, an agreement to repay any portion of the grant which is not used for the purposes it was intended. Number 2, the grantee must agree to submit full and complete annual reports on the manner in which the funds are spent and the progress made in accomplishing the purposes of the grant. Number 3, agree to maintain records of receipts and expenditures and to make its books and records available to the grantor at reasonable times. And number 4, agree not to use any of the funds for prohibited purposes. And those prohibited purposes are the things that basically a private foundation cannot do, which includes carrying on propaganda or otherwise attempting to influence legislation, trying to influence the outcome of a specific election, or to carry on directly or indirectly any voter registration drive that's not otherwise allowable. The grantee is prohibited from making any grant which doesn't comply with the requirements of the taxable expenditure rules. And fourth, the grantee has to agree not to use the funds to undertake any activity for a purpose other than one that's allowed under the Internal Revenue Code for a charitable organization. The written commitment requirements are strictly construed by the IRS and the courts, so all of these elements should be in the written ER grant agreement. And one other detail, for an ER grant to a for-profit business, the grantee has to agree to hold the funds in a separate segregated account. So that's the second element. To recap, we covered pre-grant inquiry and we covered the written commitment. Next, the third part is the grantor foundation must obtain full and complete reports from the grantee on how the funds are spent. The reports from the grantee must describe how the funds were used, whether or not the grantee complied with the terms of the grant, and the progress made by the grantee toward achieving the charitable purpose for which the grant was made. Generally, the grantee must make these reports at the end of each annual accounting period within which the grant or any portion of it is received, and which is when it's still held. Most foundations require interim annual grant reports as well as a final report. Special rules apply for capital endowment grants to certain exempt private foundations. So not to worry, if it's an endowment grant, you don't have to get reports forever. There is a limit to that. Special rules apply. Now on to the fourth requirement. The grantor must also make full and detailed reports with respect to the ER grants to the IRS on the annual Form 990-PF. And the 990-PF requires 7 points to be disclosed for each ER grant. The name and address of the grantee. 2, the date and amount of the grant. 3, the purpose of the grant. 4, the amounts expended by the grantee. 5, whether the grantee has diverted any of the funds. 6, the dates of any reports received from the grantee. And 7, the date and results of any verification of the grantee's reports, which the grantor undertook. So finally, the last ER requirement or element of these 5 we've been talking about is the requirement that the grantor must maintain and make available to the IRS, if requested on audit, copies of each of the following 3 things for each ER grant. 1, the written agreements covering the grant made. 2, the reports received during each taxable year from each grantee for each ER grant. And 4, investigation reports that show the grantor's personnel or independent auditors did the appropriate investigation for each ER grant. So that's the 5 elements for how to satisfy the ER requirements. So I promised earlier on that I'd talk a little bit more about the penalty for failing to meet the ER requirements. They are significant. First, there's the initial tax. This initial tax is imposed on the grantor foundation in the amount of 20% of the grant that was made. If a foundation manager knowingly, willfully, and without reasonable cause agrees to a taxable expenditure, there's also an initial tax on the manager, which is 5% of the amount spent, up to a maximum tax of $10,000 for any grant that doesn't meet the ER requirements. However, the foundation manager isn't liable for the tax if he or she can show that it was due to reasonable cause and not willful neglect, and that the expenditure was corrected within the required correction period. A foundation manager who acts on advice of counsel, given in a reasoned legal opinion in writing, is not ever going to be liable for the foundation manager tax. So the foundation manager tax very, very rarely comes into play, but it's an important feature of these rules to make sure that foundations don't glibly ignore the ER requirements. But anyway, there is more. If our grant that should have been an ER grant isn't corrected within a required period of time, called the taxable period, the IRS imposes an additional tax of 100% of the amount spent. This additional 100% tax is imposed on the foundation, not the foundation managers. It's important to keep in mind that the second level tax isn't assessed, or if it's assessed, it will be abated if the expenditure is corrected within the correction period. Any foundation manager who refuses to agree to any part of the correction has to pay an additional tax of 50% of the expenditure, up to a maximum tax of $20,000. And again, the foundation manager is rarely going to be responsible for the second level tax if the actions in proving the erroneous grant is due to reasonable cause and the manager has exercised their responsibility on behalf of the foundation with ordinary business care and prudence. And a final note on that, if more than one foundation manager is liable for either the initial or additional tax, all of the foundation managers are jointly and severally liable. So again, not something to be taken lightly. So what happens? You find out late in the game that due to just errors, somebody didn't realize that a grantee wasn't public charity. They should have exercised ER. How does one go about correcting a taxable expenditure? Obviously, it's always better to make the correction before the IRS finds out about it. Once the problem is discovered, if the managers take the appropriate actions to try to correct it, all should be well in the long run. So let's go back and talk a little bit about the purpose of the correction provision in Section 4945. The purpose of correcting is to require a private foundation and its managers to take all reasonable steps to return the foundation to the position it was in before it made the taxable expenditure. So this generally involves recovering as much of the grant as possible. If the problematic grant can't be fully recovered, the grantor needs to take care that it doesn't make the same mistake again, typically by noting that the particular problematic grantee is flagged so that future grants aren't made to it that would also be taxable expenditures. Or if the IRS has become involved, the grantor foundation can meet the correction requirements by taking any additional corrective action that the IRS requires. Where a taxable expenditure results from more general problems involving a foundation's overall grant-making procedures, the foundation really should consult with tax advisors to set up improved methods for exercising expenditure responsibility when required. Now, there's a nuance to think about here, and that is if a taxable expenditure results from failure to satisfy the reporting requirements, correction in that case often involves simply obtaining or making the required reports, rather than the recovery of the funds granted. If an amount is treated as a taxable expenditure only because the grantor private foundation failed to obtain a full and complete report, then if the grantor investigates and determines that in fact no grant funds were misused, and the grantor makes reasonable efforts to obtain the report in question, even if the report is not finally obtained from the grantee, if that grantor foundation reports these failures to the service, that may be sufficient correction under the circumstances. Obviously, the grantee that failed to provide the required reports, for whatever reason, should be flagged so that the grantor doesn't make any more grants to it. That would be covered in due diligence for a future grant. So, it circles us all the way back to the pre-grant inquiry. You want to make sure when making the pre-grant inquiry that there aren't any problems with previous grants to that grantor. Anyway, so that about covers it. As we've talked about in this episode, when a private foundation fails to comply with any of these rules for a grant that is not made to a public charity or an exempt operating foundation, then the grant will be a taxable expenditure and subject to the penalty tax. That is, unless the ER rules are complied with. So as we've shown, the ER rules are not really all that complicated, but failing to meet all of the requirements exactly as written can lead to stiff penalties. So that's all for this episode. Be sure to check out the show notes for links to more resources on the ER rules. I am Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun & Martel. If you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.